What's up guys, so the official UK property market numbers for April are now out. So I'm back with another video to summarise what we've seen in April for this year so far in the UK property market, and to go into a bit more detail to explain what's driving the demand, the supply and the growth in the prices in our property market. So let's do a quick exec summary of what we're seeing. The price growth for this month is 4.1%. Last month it was 4%, and the month before that it was around 4%. So that's pretty consistent in terms of the growth. And that growth covers a 12-month period from April 2020 to April 2021. Demand is up to 29%. Last month it was at 27.5%. So again, record demand for properties in the UK. And again, we're going to look at a breakdown of the specific types of properties that are being demanded by buyers in the UK and why. And then the biggest change from last month is a change in the flow of new supply of houses. So we're still in minus territory, guys. If you remember from last month, the figure was minus 6.1%. And what that meant was for the 12 months to March 2021, there was 6.1% less houses than there were for the 12 months to March 2020. So still a reduction in supply compared to this time last year for those 12 months. But that lack of supply is slowly getting smaller and smaller. And again, we'll look at what's causing this later on in the video. So let's start with the growth in house prices. Now we're seeing a figure of 4.1% here. Important to remember, guys, that this figure is based on 20 cities in the UK. Now I'm going to scroll down so you can see what those 20 cities are. And you can see these 20 cities summarized here at the end of this document. Now, obviously in the UK, there are more than just 20 cities. So this 4.1% that you see summarized and that we touched on at the beginning of this video is based on an average of just these 20 cities. Now, what we really want, guys, is the average across the whole of the UK. And we can go to the land registry for this. Now, the land registry is a record of all of the sold houses in the UK over a certain period. So whenever a house is sold in the UK, that gets uploaded into the UK Land Registry. Now let's have a look at what the stats are for the last 12 months according to the Land Registry. So in March 2020, the average price of a property in the UK was £232,684. Go forward 12 months to March 2021, the average price is now £256,405. That is a 10.2% rise in the average price of a UK property. Remember that number, guys, 10.2% for the whole of the UK, compared to 4.1% for these 20 cities. Obviously a big difference between 10.2% and 4.1%, but I understand why a company like Home Track, they're not a government entity, they don't get access to all of the transactions in the UK, so they're focusing on the top 20 cities in the UK. So a 10.2% rise in the price of an average property in the UK, that is huge, guys. It's good news for the economy. Usually when you see a boom in property market, it's a sign of people's optimism in the economy. And obviously the media are delighted about this. Just kidding. They're already predicting the next property market crash. We've literally had 12 months of a decent level of growth in the property market, and we've already got this pessimism from the media. Guys, that is why I say when you're investing, whether it's in property, stocks or any other type of asset, try to screen out what the media is saying to you, because usually it's sensationalist headlines that really aren't focused on the data or the fundamentals. So let's have a look at what this article is actually saying. It started off by talking about new property price records being broken, which of course is factually correct, and that it's more expensive now to buy a property than it was last year. Yet there's been a 10% rise according to the data from the Land Registry that we just looked at. And here's where my eyebrows start to rise, guys. They're saying the last time house prices increased by these kind of rates was in the lead up to the financial crisis of 2008, 2009, the last economic crash. And are there growing fears that we're set for another collapse? Well, not really, because the circumstances surrounding this rise in property prices is completely different to what happened in 2008, 2009. And they actually acknowledge this further on in the article. So talk about one of the major influences behind the sharp rise in prices being the stamp duty holiday, which was brought on by Rishi Sunak in the last budget, which I covered in my last video. They go on to reiterate the obvious, guys. You know, there's a huge surge in people buying houses because they want to take advantage of the tax break. If you do not have to pay thousands of pounds worth of stamp duty for a period and you're planning on buying a house, of course you're going to bring it forwards to make that huge saving. But right here, guys, is where there's obvious lack of understanding of how the property market now is different to how it was in 2008. I joined the banking industry in 2008, guys, while the crash was going on, and I dealt with a lot of distressed property portfolios. So what this article says here is that it's not worth buying right now whilst prices are rising if you're unable to afford the home that you've just bought later down the line. What they're missing here is that because of the last crisis in 2008, 2009, which is very much specific to property, regulation was brought in by not just our government, but many other governments around the world, controlling how banks lend on property. You have what we call now stress tests and affordability criteria, which basically prevents banks from giving out mortgages like confetti, as they were doing in the lead up to the 2008 crash. There's a hilarious scene in the Wolf of Wall Street movie with Leonardo DiCaprio, which really summarizes this. It's a scene with a stripper, and she's basically saying how easy it was to get mortgages and build a huge property portfolio despite having no traceable income. Now, I don't know any strippers, but what I do know is that they're paid cash in hand. So she's very unlikely to have gone to the bank with wage slips or annual accounts, unless, you know, strippers work through limited companies. I don't know how it works, guys, but the point is, it was highlighting the fact that it was incredibly easy to get 100%, even 110% mortgages prior to 2007, 2008. And this article really misses how that's been rectified since then. They also talk here about mortgages requiring just a 5% deposit are back, insinuating that it's a bad thing. Again, the 5% deposit mortgages that existed prior to 2007 versus the ones now are completely different products, guys. The 5% deposit mortgages that you see now are backed by the government. The ones prior to 2007, 2008 were backed by nobody. So they were much higher risk to the banks and to the economy. As we saw, the economy crashed basically off the back of these mortgage products that people couldn't afford and that had no guarantees sitting behind them. And we also mentioned that now there are affordability and stress testing criteria that are mandatory when it comes to mortgage lending in this country now. And then here's where I really start to question this article, guys. It says that we're going to build back better from the pandemic and that we're talking about recovery built on cheap money and property speculation. Guys, I don't know about you, but who in our economy right now is speculating on property? Property speculation, guys, entails that institutions and people are just taking huge speculative punts on property. There's not a lot of developers building on new developments, let me put it that way. There's not a lot of individuals taking up property development like there were prior to 2008. There's not a lot of people paying over the odds for properties and then selling them on at a profit 6 months later. That's just not the property market right now. It's just not in a current state right now where large amounts of people and companies can profit from speculation right now. Now, yes, we've had a really good year, and if that continues, maybe we could edge towards that or move towards that where people can start speculating in property. But that's just not the market right now, guys. So again, read articles like this critically and really analyze what people are saying. Don't just take headlines at face value, because a lot of the times, guys, it's not based on a good understanding of how property and the economy works. Some people might even say that these articles are written for clickbait. Not me, but some people. So now let's move on to demand, guys. Buyer demand is still huge. We saw that it was 29%. That's a record high level, guys. And what's driving that is people really assessing where they want to live, what areas they want to live in, what type of houses they want to live in, the space and their surroundings, which has really been prompted by the global pandemic. I quoted this stat in a previous video, guys, but we saw 500,000 people leave London during the last 12 months. And we see this coming through in the numbers. 461 billion worth of sales over the past year. That's 46% higher than last year. I mean, that's a huge increase, and 68% higher than the year before. What's driving that? The increased prices due to a rise, record highs in demand and a lack of supply. And you can also see this in the number of transactions. So right here, it's saying that there's projected to be 1.5 million property transactions by the end of this year. And the last time that this number was topped was 2007. So before the last economic crash, 14 years ago. Huge numbers that we haven't seen in over a decade, guys. Now let's have a look at what's happening with supply. Now, according to Zoopla, supply of family homes falls to a 5-year low. Why is this happening? Well, primarily because in light of the pandemic, buyers are so keen for more space, particularly 3 and 4 bedroom homes, that it is far outstripping supply. There just aren't enough houses being made available on the market right now to match the demand for these. And then when we look at why this is happening, not only is demand greater than supply in total aggregate terms, there are actually less properties on sale this year than there was in 2020, 20% less to be exact. So in summary, we've seen this kind of once in a few decades surge in demand for property driven by the pandemic, but also the stamp duty holiday that was introduced in the budget, coupled with a lack of supply due to a lot of people still wanting to delay listing their house until after the pandemic. Tell me about you guys in the comment section below, but there are a lot of people that I know who said that they weren't planning on selling their home until the pandemic is over because they feared that they weren't going to get the best price possible, when actually the opposite is true. And when you drill down into the detail, there's a particular shortage of 3 and 4 bed homes across the UK. People really want larger houses, they want more space. And then lastly, let's look at what regions in the UK are really performing the best. So when we look at this map, we can see that Wales, the North West, and also Yorkshire and Humber are the 3 regions in the UK that are performing the best from a price growth perspective. London is doing the worst. It's really struggling from a price growth perspective, guys. Now, why is this? Well, one of the theories that I have, guys, is you've got to go back in time. Here is the land registry data for London. These are sold properties dating back from January 2007 till present day, March 2021. Now, before the crash in 2008 and London hit its lowest point in the last 15 years in April 2009, London peaked at around just under £300,000. As I said, it hit its bottom in April 2009, and then it recovered again to £300,000 in April 2012, 3 years after it hit its low. Now let's look at the same for Wales. Wales hit its peak out of about 150 around October 2017. It hit its low approximately the same period in March 2009, and it didn't reach its high of 150 again all the way until June 2017 right here. 10 years after the crash, guys. The same is true of the Northwest. You see that lowest point in March 2009, and it doesn't get to 150 until, again, April 2017, 10 years after. And the same is true with Yorkshire and the Humber. High of 150, hits its bottom in March 2009, and it doesn't reach 150 again until 9 years later in June 2016. Why am I showing you this? I'm showing you this because we saw at the beginning that London basically took 3 years to get back to where it was prior to the last major economic crash, whereas the other regions took 10 and 9 years. Call it 10 years on average. There's a pattern there, guys. London, being the capital city of the UK, usually is the first when it comes to recovery, and then the rest of the major regions around the UK follow in a lagged effect. London moves a lot quicker. We're seeing 3 years here. The other regions, we're talking about 10 years, an extra 6 to 7 years. Now in London, from 2012 to around about end of 2016, you saw very steep growth in London, and now it's tailed off. That rate of growth is flattened out. Now we just saw that the other regions are experiencing really sharp growth. I believe that the other regions are essentially doing this growth that London has done, but in a lagged effect. Because as we saw, London goes first and the other major cities of the UK tend to follow. And I believe that's what's happening now, which leads me on to what this means for you. London is not the only city in the UK to invest when it comes to property. It's very easy to believe that. Obviously, property prices are higher and a lot of the media attention is London focused. But guys, don't sleep on the other regions. I myself invest in Liverpool, in Sheffield, and I'm looking to invest in a lot more regions in the Northwest and also Yorkshire and the Humber. So study the data, guys, and invest smartly. I hope this was a helpful summary of this month. If you have any other ideas of what you want me to talk about as it relates to property that you want me to cover, let me know in the comments section below, and I'll see you guys soon.